In this video, we will share key takeaways from the Economic Survey Report of India 2025-2026 presented on 29th January 2026 before the Parliament of India. Honorable Finance Minister Shrimati Nirmala Sitharaman's suggestions in the process, insights and perspectives prompted deeper reflection and enriched the whole exercise profoundly. In the preface of the report, Chief Economic Advisor of India, Mr. V. Anantha Nageswaran, shares that although the President of United States announced reciprocal tariffs of 25% on India in April, India was expected to strike an early agreement with the US administration and lower them. So, in August, when the American president announced an additional penal tariff of 25% on most of India's merchandise exports to United States, on top of the reciprocal tariff of 25% announced in April, it surprised many since India was expected to be one of the early winners in the new tariff regime of the United States. Growth forecasts were revised downwards, but in reality, growth accelerated due to a slew of structural reforms and policy measures. India is now anticipating a full year real growth rate of over 7%, with another year of real growth at or near 7%. There is one wrinkle in the ointment, however. The paradox of 2025 is that India's strongest macroeconomic performance in decades has collided with a global system that no longer rewards macroeconomic success with currency stability, capital inflows, or strategic insulation. The Indian rupee underperformed in 2025. India runs a trade deficit in goods. Its net trade surplus in services and remittances is not enough to offset it. India depends on foreign capital flows to maintain a healthy balance of payments. When they run drier, rupee stability becomes a casualty. The rupee's valuation does not accurately reflect India's stellar economic fundamentals. It does not hurt to have an undervalued rupee in these times, as it offsets to some extent the impact of higher American tariffs on Indian goods, and there is no threat of higher inflation from higher priced crude oil imports now. However, it does cause investors to pause. Investor reluctance to commit to India warrants examination. Recently concluded free trade agreement with the European Union after 3 years of negotiations will now require ratification by the European Parliament. In the current global context, the agreement expands market access for India's labor intensive manufactured exports while enabling deeper integration with Europe's technological and manufacturing capabilities. The FTA with Europe can support the continent's efforts to revitalize parts of its manufacturing base and at the same time strengthen India's manufacturing competitiveness, export resilience, and strategic capacity. Realizing the potential of trade agreements requires that we can produce competitively. The principal strategic risk for India is less about any external shock, but more about a mindset that downplays structural discontinuities. The country stands to gain immensely when all of us embrace delayed gratification. The global environment is being reshaped by geopolitical realignments that will influence investments, supply chains, and growth prospects for years to come. Against today's global churn, India must choose to build resilience, innovate relentlessly, and stay the course towards Viksit Bharat rather than seek quick fixes to visible short term pressures. The report has 16 chapters, which discuss the first chapter discusses state of the economy and pushing growth frontier. Economic survey projects real GDP growth in financial year 27 in the range of 6.8 to 7.2%. Since the last version of economic survey was published, the global economy has been subjected to multiple upheavals. The most disruptive amongst these disturbances was imposition of tariffs by USA on imports from its trade partners. Growth in US has remained strong, primarily driven by investment in artificial intelligence. Total IT investment, which also includes spending by business on equipment and software to facilitate AI use, has accounted for nearly half of GDP growth in recent quarters, helping to mitigate negative effect of trade tariffs on growth. While inflation in Europe is broadly trending towards European Central Bank's target, growth in region's economies has been mixed. Forecasts by European Commission indicate that growth rates in Germany, Italy and France are expected to remain moderate while Spain is anticipated to outperform. In Asia, the Chinese economy continues to face deflationary pressures amid headwinds stemming from the crisis in its property sector, indicating tepid domestic demand even as Chinese merchandise exports remain a key driver of its growth. Growth in Japanese economy remains moderate, while inflation continues to exceed the Bank of Japan's target of 2%. Global economic uncertainty remains elevated compared to historical trends, primarily on account of fragmentation in geopolitical relationships and lower visibility on policy continuity. This, coupled with the aforementioned macroeconomic developments, has led to deterioration in global foreign direct investment flows. Rapidly evolving country alignments and supply chains, as well as technological developments, necessitate supplementing traditional economic assessments with a geopolitical perspective. First advanced estimates for financial year 26 released by the Ministry of Statistics and Program Implementation place the real GDP growth rate at 7.4%. Domestic demand continues to underpin economic growth in financial year 26. According to FAE, the share of final private consumption expenditure in GDP rose to 61.5% in 26, the highest level since FY12. This is corroborated by strong performance during first half of the year, with PFCE growing by 7.5% in H1 of financial year 26 and its share in GDP rising to 61.4%. This is fastest growth rate since first half of 23 and remains higher than pre-COVID trend of 6.9%. Strength in consumption reflects supportive macroeconomic environment characterized by low inflation, stable employment conditions, and rising real purchasing power. Moreover, steady rural consumption, bolstered by strong agriculture performance and gradual improvement in urban consumption, aided by rationalization of direct and indirect taxes, reaffirm that momentum in consumption demand is broad based. Key high frequency indicators for third quarter of financial year 26, including automobile and tractor sales, as well as air passenger traffic, signal continuation of robust demand conditions. In the November 25 round of NABARD Rural Economic Condition and Sentiment Survey, 79.2% of rural households reported increased consumption during last year, with share of monthly income spent on consumption rising to about 67%, highest since survey's inception. This buoyancy in consumption demand can be attributed to positive impact of GST rate rationalization and softer inflation, improving real purchasing power of rural non-farm income. Investment has continued to anchor growth in financial year 26, with share of gross fixed capital formation estimated at 30%. In first half of financial year 26, exports of goods and services grew by 5.9%, exceeding growth seen in the same period last year and remaining above pre-pandemic average, supported by trade diversification. Services exports have continued to provide stable anchor for growth, partially offsetting greater volatility in goods exports amid tariff related uncertainties. Agriculture has provided stabilizing force, with output supported by favorable monsoon conditions and steady value addition from allied activities. Manufacturing was primary driver, expanding by 8.4%, reflecting resilient demand conditions and improved utilization of existing capacities. Capacity utilization in manufacturing remained above its long run average during this period. Growth in electricity, gas, water supply, and other utilities were relatively modest at 2.4%, lower than pre-pandemic trend. Mining sector contracted by 1.8%, partly due to disruption caused by excessive rainfall. Despite weather-related disruption, construction activity recorded 7.4% growth, lower than in H1 of 25, but underpinned by sustained public capital expenditure and ongoing momentum in infrastructure projects. Construction indicators such as steel consumption and cement production have witnessed a steady growth. Services, true to its label as stabilizing component of GVA, is estimated to have grown by 9.1% in financial year FY26, up from 7.2% in FY25, indicating further acceleration in services-led expansion. Trajectory of core inflation will need to be closely monitored in context of monetary policy easing and potential upward pressures from global base metal prices. Gross tax revenue collection has progressed resiliently during the year, with direct tax collection reaching nearly 53% of budgeted annual targets. Indirect tax collections also remained robust despite lower inflation and import volatility, with gross GST collections in absolute terms recording multiple all time highs during the year. Recent tax policy reforms, including restructuring of personal income tax and rationalization of GST rate, have supported consumption demand while sustaining revenues. Even as the states are overshooting revenue deficit, central government, through its special assistance to states for capital expenditure and investment, has successfully incentivized the states to maintain capital expenditure at around 2.4% of the GDP. India's commercial sector is stepping into alternative sources of financing, thereby offsetting any moderation in bank credit. Faster transmission of monetary policy has enabled market based financial instruments to serve as a viable funding source for large corporations. Additionally, as profitability of this corporation has grown over time, internal resources have become available for business growth. Together, these trends have decreased reliance on bank credit. Against a backdrop of global trade uncertainty, India's total exports, merchandise, and services reached a record 825.3 billion US dollar in financial year 25 with continued momentum in financial year 26. The current account deficit remains moderate at 0.8% of GDP in H1 financial year 26. Gross FDI inflows continue to rise significantly, growing by 16.1% year on year in April to November 25, while repatriation flows have marginally declined by 4.2%. Increase in FDI by India abroad of 34.9% over this period capped the growth at net FDI. Foreign portfolio investments have experienced fluctuations with 3 months of sizable net inflows and 6 months of net outflows from April to December 25, resulting in modest net outflow of 3.9 billion US dollar as of December 25 compared to net inflows of 10.6 billion US dollars in corresponding period of previous year. FPI flows this year have been tepid due to elevated uncertainty and increased interest in AI related financial investments in countries such as US, Taiwan, and Korea. As a result, there was balance of payment deficit of 6.4 billion US dollar in financial year 26 compared to surplus of USD 23.8 billion dollar in financial year 25, which was funded by decline in foreign exchange or the forex reserves. This widened balance of payment deficit, coupled with market uncertainty over outcome of trade deal with the US, has exerted pressure on Indian rupee, causing it to weaken. Between April 1 and January 22, 2026, the Indian rupee depreciated by approximately 6.5% against US dollar. Over the medium to long term, exchange rate dynamics are expected to be guided by structural fundamentals such as productivity gains, export diversification towards higher value goods and services, deeper integration into GBCs, and stable economy policy environment rather than short term fluctuation. Forex reserves cover over 11 months of import as of 16 January 2026 and approximately 94% of external debt outstanding as of end of September 25, offering comfortable liquidity cushion. The pursuit of diversified trade strategy, as evidenced by signing of trade agreements with UK, Oman, and New Zealand, and the EU, and active negotiation with US bodies, well, for growth of India's exports. However, global developments are complicating the outlook in medium term. Proliferation of immigration controls across countries, typically favored by Indian immigrants, may cap growth in remittances. Global trade is being increasingly influenced by geopolitical alignments and economic statecraft, which in turn may impact India's exports. Therefore, it becomes imperative that one of the overarching priorities of India's policy must be to enhance its competitiveness on global stage and improve its attractiveness as an investment destination. Union government's landmark step of notifying implementation of labor codes marks significant reform in regulatory framework. Consolidation of 29 central laws into 4 labor codes aims to simplify compliance, enhance labor market flexibility, and extend security to broader section of workforce while maintaining safeguards for wages, occupational safety, and social security. Importantly, recognition of gig and platform workers with provisions to enable registration and inclusion in social security schemes marks step towards formalizing non-traditional forms of employment. Complementing these reforms, government-led skilling initiatives have focused on enhancing employability through industry-aligned training. Together, these measures aim to strengthen labor market resilience, improve job quality, and better align workforce capabilities with requirements of rapidly changing economy. Social sector initiatives supported by targeted welfare schemes, economic reforms, and expanded access to essential services have contributed in reduction in poverty levels. In June 25, World Bank revised the international poverty line from 2.15 US dollar to 3 US dollar per day. Based on revised poverty line, India's poverty rates in 22-23 are estimated at 5.3% for extreme poverty and 23.9% for lower middle income poverty, noting that these estimates are not directly comparable with earlier poverty lines. Life expectancy, infant, infant mortality rate, and gross enrollment ratio have shown steady improvement, indicating gains in overall health outcomes, maternal and child health, access to education, and human capital formation. Slower growth in key trading partners, tariff induced disruptions to trade and volatility in capital flows could intermittently weigh on exports and investor sentiment. At the same time, ongoing trade negotiations with United States are expected to conclude during the year, which could help reduce uncertainty on external front. Second chapter of fiscal development talks about anchoring stability through credible consolidation. The fiscal deficit declined from 9.2% of GDP in financial year 21 to 4.8% of GDP in financial year 25. Revenue deficit as proportion of GDP has narrowed steadily, reaching its lowest level since financial year 2009, thereby leaving a greater allocation for capex and reflecting sustained improvement in quality of expenditure. Decline in primary deficit to GDP ratio during this period indicates that fresh borrowings are now increasingly being used to service past interest obligations rather than to finance current spending. Revenue receipts increased from an average of about 8.5% of GDP during pre-pandemic period to around 9.1% of GDP in post-pandemic period. This improvement was driven by higher gross tax revenue, which rose from an average 10.8% of GDP to about 11.5% of GDP over same period. Buoyancy of revenues reflects both strong growth momentum of domestic economy and cumulative impact of tax policy and tax administration reforms implemented by the government. Share of direct taxes in total taxes have increased in past 5 years from 51.9% in pre-pandemic period to 55.5% in post-pandemic years, reaching 58.8% in financial year 2025. The number of income tax returns filed increased in post-pandemic period from 6.9 crore in financial year 22 to 9.2 crore in financial year 25, reflecting gains from improved compliance, wider technology use in tax administration, and growing number of individuals entering tax net as their incomes rise. According to Reserve Bank of India, aggregate corporate profits of listed companies have increased from around 2.5 trillion in financial year 21 to 7.1 trillion in financial year 25, resulting in more than 100% increase in corporate tax collections over this period. Personal income tax collections grew by 6.8% year on year, and corporation tax collection increased by 7.8% year on year during the period, reflecting various tax concessions granted during this period. Union Budget 25-26 ushered in significant income tax relief for middle class with no personal income tax payable for income up to 12 lakhs, 12.75 lakh for salary taxpayers, alongside changes in slabs and rates as well as in TDS rules. New Income Tax Act 2025, which focuses on simplification, structure clarity, and continuity of tax policy, was enacted on 21st of August 25, is slated to take effect from tax year 26-27. Among major indirect taxes, excise duty collections moderated in post-pandemic period, declining from about 1.7% of GDP in financial year 22 to around 0.9% of GDP in financial year 25. This moderation was driven by reductions in excise duty rates on petroleum products in 21 and 22, along with relatively moderate growth in petrol and diesel consumption during financial year 24 and 25. While excise duty collections witnessed growth of 9.3%, customs collections have reduced by 7.3% on year basis. The goods and services tax has played stabilizing role by strengthening government revenues, deepening formalization, and reinforcing the government's reform intent. Gross GST revenue during April to December 25 stood at 17.4 lakh crore, recording a year-on-year growth of 6.7%. The e-way bill system emerged as effective digital substitute, enabling online tracking of goods movement while supporting tax administration objectives without reintroducing physical barriers at the state borders. Technology has evolved over time, as have the needs of modern business and logistics. Mobile-based checks of e-way bills and interior points may at times lead to avoidable disruptions in logistics and compliance friction for bona fide trade. The non-tax revenues of center as percentage of GDP have broadly remained stable at around 1.4% of GDP in the post-pandemic period, in line with pre-pandemic average, providing steady support to center's revenue receipts. Improved performance of central public sector enterprises has also contributed to growth in center's non-tax revenues. Between financial year 20 and financial year 25, gross turnover per CPSC increased by approximately 32%, while net profits and dividends per CPSC went up by 174% and 69% respectively. Going forward, receipts from equity monetization can be strengthened by selectively reducing government equity in certain CPSCs beyond minimum public shareholding norms, guided by market conditions and enterprise specific factors. Currently, in about 30% of listed CPSs, Government shareholding is already below 60%, limiting further disinvestment through OFS as it is stipulated in Companies Act that a government company must have at least 51% of its stake held by the central or state government. Since effective control requires only about a 26% stake, government could consider amending the definition of government company under Companies Act limited to listed entities to allow them to remain as government companies with a minimum of 26% ownership, thereby retaining special resolution rights while enabling government to monetize its stake. Alternatively, if objective is eventual privatization, government could continue phased OFS below 51% and even towards full exit without changing legal definition of government company. This would enable CPSs to function post disinvestment as professionally managed entities with dispersed ownership, clear governance standards, and transparent succession frameworks. A portion of disinvestment receipts could also be earmarked for strategic investments in emerging technology and innovation driven companies through professionally managed platforms such as National Investment and Infrastructure Fund, thereby recycling public capital towards future growth sectors. This will ensure steady stream of disinvestment receipts into the future. Revenue expenditure has moderated from 13.6% of GDP in financial year 22 to 10.9% in financial year 25. Large share of revenue expenditure covering salaries, pensions, interest payments and defense is committed in nature, highlighting importance of rationalizing discretionary spending. In addition, streamlining design of subsidy schemes, efficiency gains from direct benefit transfer framework have played key role in reducing subsidy outlays by curbing fiscal leakages estimated at 3.48 lakh crore over the past decade. During current fiscal year, capex recorded a strong rebound, rising by 28% year on year as of end of November 25. For financial year 26, 15th Finance Commission has recommended 1,47,827 crore as grant in aid to states under Article 275 of the Constitution of India. These grants comprise post devolution revenue deficit gains, grants to local bodies, including health sector grants and disaster management grants. The XVFC has recommended a net borrowing ceiling of 3% of GSDP for the states in financial year 26. In addition, states may avail performance linked additional borrowing of up to 0.5% of GSDP for power sector over and above normal borrowing ceiling. States are permitted to borrow over and above normal borrowing limits by an amount equal to pension contributions that they deposit under National Pension Scheme with the designated authority NSDL or the trusted bank. For financial year 26, this translates into additional borrowing space of 69,769 crore as of November 17, 25. This additional borrowing is intended to address divergence in pension accounting across states, whereby those following a pay as you go system report lower fiscal deficits as their future pension liabilities are not explicitly reflected, whereas states following NPS incur a current expenditures that enlarges fiscal deficits. State deficits have gradually edged up again over past 3 years to 3.2%, reflecting emerging pressure on state finances. Excluding SASCI, the scheme for special assistance to states for capital investment under the center provides 50-year interest-free loans to states exclusively for capital expenditure. Fiscal deficit is back on the range of 2.8%. Combined revenue receipts of the states have grown at a rate of 6.6% during first 8 months of year, which is lower than year-on-year growth of previous years. Rollover interest rate and foreign currency risks have been contained through prudent debt management strategy. Rollover risk has been reduced by consciously elongating maturities, supported by switch and buyback operations, with the weighted average maturity of fresh issuances remaining around 19 years, and that of outstanding dated securities rising to 13.66 years in financial year 25. Consequently, only 27% of outstanding debt is set to mature over next 5 years, implying average annual rollover of about 5.4%, indicating manageable refinancing needs. Interest rate risk has been limited by maintaining predominantly fixed rate debt profile, with floating rate debt accounting for just 4.1% of outstanding debt at end of financial year 24, ensuring predictability of interest costs. Foreign currency risk remains low due to the country's reliance on domestic currency borrowing, with external debt accounting for small share of liabilities, approximately 2.6% of GDP, largely sourced from multilateral institutions on long term concessional terms, thereby insulating public debt from exchange rate and external shocks. Monetary management and financial intermediation chapter talks about refining regulatory touch. Monetary management led by Reserve Bank of India involves regulating the money supply, interest rates and liquidity to ensure price stability while supporting sustainable economic growth. It directly influences financial stability. Effective policy transmission through banking and financial sector ensures changes in interest rate and liquidity conditions are efficiently transmitted to businesses and households. This is crucial for sustaining growth and preventing financial crisis as stable financial system enables smooth allocation of resources and fosters economic resilience in face of global and domestic shocks. Impact of uncertainty on financial markets is not limited to rise in volatility and risk. Research shows prolonged period of uncertainty can affect financial sector through at least three key channels. First, financial market participants are seen to defer decisions in presence of uncertainty. A rise in uncertainty will trigger a wait and see sentiment, delaying investments and capital formation. Second, heightened uncertainty can raise cost of finance through rise in credit spreads and financial intermediation costs. In turn, this can impact real economy by impeding the flow of credit. Finally, prolonged uncertainty can increase possibility of sharper market corrections across asset classes. In some cases, these market corrections can pave way for financial contagion, spreading to entire financial sector and real economy. In addition to above risk, global financial markets grapple with impact introduced by new technologies such as artificial intelligence. The IMF's Financial Stability Report of October 25 notes there is higher likelihood of herding behavior in financial markets as global investors use similar AI models. The report also notes that compared to previous decades, investors have become increasingly sensitive to micro information signals transmitted through social media. At the same time, digital assets such as stablecoin are gaining traction and playing larger role in financial intermediation. As of 31st December 2025, total market capitalization of stablecoins stands at 305.4 billion US dollars, marking 49.6% increase in this year. Stablecoins, rising market capitalization, and increasing interconnections with traditional financial system have reached a stage where potential spillovers to that system cannot be longer ruled out. The RBI's Monetary Policy Committee cumulatively reduced the repo rate by 100 basis points during its meetings from April to December 2025. As of December 2025, repo rate stands at 5.2%. These reductions were aimed at boosting credit flow, investment, and overall economic activity. RBI also announced 100 basis points reduction in cash reserve ratio to 3% of net demand and time liabilities implemented in a staggered manner. Along with 100 basis point cuts, RBI also injected durable liquidity of 2.39 lakh crore rupees through 9 open market operations purchases during April to May 2025. In terms of sectoral deployment of non-food credit, among the categories of agriculture and light activities, industry services and personal loans, highest year-on-year growth has been observed in personal loans with increase of 12.8% in November 25. Significant factor contributing to this growth is substantial rise in loans against gold jewelry, which have increased by 125.3%, likely due to increasing prices of gold. Between financial year 20 and 25, there has been notable increase in overall flow of resources to commercial sector demonstrating compounded annual growth rate of 20.9%. This flow has increased from 13.6 lakh crore in financial year 20 to 35.1 lakh crore in financial year 25. Further, within non-bank sources, foreign sources experience greater year-on-year increase as compared to domestic sources. In financial year 26, as of 31st December 25, while former have experienced growth of 38%, latter have experienced growth of 19.1%. This increase in foreign sources is driven by a significant rise in external commercial borrowings by non-financial entities, which increased from 5,000 crore to 27.7 thousand crore, and FDI to India, which increased by 67%. The increase in domestic sources is attributable to rise in corporate bond issuances by non-financial entities, which have experienced 263.3% growth. It is important to note that concurrent increase in flow of financial resources to commercial sector bolstered by greater non-bank intermediation has accompanied the slowdown in bank credit growth in early financial year 26. This trend indicates that non-bank sources have effectively offset the decline in bank credit. Central bank will replete 9,446 circulars, of which 3,809 have been incorporated into master circulars, while remaining 5,673 have been deemed obsolete. This exercise aims to enhance clarity and accessibility while reducing compliance burden on regulated entities, ultimately supporting overarching objective of improving the ease of doing business. RBI has articulated principle-based guidance for the use of AI. It has introduced free AI framework for responsible artificial intelligence, which is designed to foster financial innovation while ensuring robust risk management. India's microfinance sector also represents a key channel for advancing grassroots development. With 95% women borrowers and 80% rural clientele, this sector addresses segments where credit access has historically been limited. Over past decade, microfinance sector has displayed steady growth, with active borrowers nearly doubling from 330 lakh in financial year 14 to 627 lakhs in financial year 25. During this period, gross loan portfolio of MFIs multiplied nearly 7 times from 33,517 crores in financial year 14 to 2,38,198 crore in financial year 25. At same time, MFI branch network expanded from 11,687 branches to 37,380. Financial inclusion initiatives include the Pradhan Mantri Jan Dhan Yojana launched in CI 2014 has opened 55.02 crore accounts as of 25 March, with 36.63 crore in rural and semi-urban areas, establishing foundational savings and transaction infrastructure for previously unbanked populations. Building on this account base, credit focused schemes have extended formal lending to undeserved segments. Stand Up India scheme offers bank loans ranging from 10 lakh to 1 crore to SC, ST, and women entrepreneurs for establishing greenfield enterprises. PM Street Vendors Atmanirbhar Nidhi PM Swanidhi scheme, launched in CY 2020, provides collateral-free working capital loans to street vendors. Pradhan Mantri Mudra Yojana, operational since April 2015, finances micro and small enterprises in manufacturing, trading, services, and allied agricultural activities. Out of the corporate insolvency resolution process proceedings closed as of September 25, 57% resulted in going concern rescue, 1300 through resolution plans, 1342 through appeal review settlement, and 1223 withdrawn under Section 12A. While 43% ended in liquidation orders affecting 2896 firms. Over time, resolution to liquidation ratio has improved from 20% in financial year 18 to 91% in financial year 25. From 1300 cases that resulted in resolution process, creditors realized 3.99 lakh crore rupees. Creditors recovered 94% of fair value of resolved businesses, 59 and 170% of what they would have received through liquidation. While haircut relative to fair value was approximately 6%, it was 67% relative to admitted claims. Data indicative of indicate that resolution, where feasible, delivers significantly better outcomes for creditors than liquidation. Bankruptcy regime still offers scope for significant improvement. Primary issues among is the presence of binding institutional constraint leading to insolvency proceedings that often stretch beyond mandated timelines. Court mandates CIRP completion within 330 days, including extensions. Actual average duration is 713 days overall and 853 days for cases closed in financial year 25. This represents deviation of over 150% from statutory limit. Compounding the insolvency timelines, the National Company Law Tribunal holds pendency of nearly 30,600 cases as of March 2025, with estimated clearance time of nearly 10 years at current disposal rates. Such extended timelines can trigger value erosion, assets deteriorate, employees depart, customers shift to competitors, and supplier relationships break down. The institutional constraint is present at level of courts as well as level of resolution professionals. 62. Only 30 NCLT benches handle cases across IBC and Companies Act jurisdiction, and RPs are also in short number. For 4527 registered RPs, only 2198 or the 49% hold active authorization for assignment. In light of extended insolvency timelines, pre-packaged insolvency resolution process was introduced in 21 to provide simpler, faster, and less costly resolution. However, PPRIP has only seen 14 admissions in 4 years. Reasons behind low take up include procedural complexity that is inappropriate for target segment, lack of awareness among MSME promoters and lenders, trust deficit regarding debtor led processes, and inability of small enterprises to fund the process. Recognizing these challenges, IBC Amendment Bill 2025 proposes a range of measures aimed at addressing procedural delays within the system, also proposes a framework for cross-border insolvency proceedings. Meanwhile, previous decade offered testament to IBC's legal framework and design. Next phase of IBC should combine process reform with rapid scaling of capacity. Total resource mobilization from primary markets encompassing both debt and equity stands at 10.7 lakh crore during financial year 26 till December 2025. IPO volumes in financial year 26 but 20% higher than financial year 25, and amount mobilized was 10% higher than corresponding period of financial year 25. Listings on the main board, the primary market for established companies meeting stricter regulatory and size threshold, rose from 69 to 94, with the amount raised increasing from 1,46,534 crore to 1,60,273 crore. A notable feature of IPO activity in financial year 26 was prominence of offer for sale components where existing shareholders sell their stakes rather than the company issuing new shares. OFS accounted for 58% of total proceeds. Sustained mobilization of resources through primary markets and widening participation of emerging enterprises through SME platform points to increasing breadth and sophistication of India's capital markets. As market activity scales up, and new intermediaries and instruments proliferate, quality of regulatory governance becomes central to preserving market integrity. In this context, Security Markets Code 2025 represents important step towards consolidating legal framework and strengthening the foundation of securities market regulation. During financial year 26, 235 lakh of demat accounts were added, pushing total count beyond 21.6 crore. Key milestone was crossing of the 12 crore mark for unique investors in September 25, with nearly fourth of them being women. Mutual fund industry also expanded with 5.9 crore unique investors as at end of December 25, of which 3.5 crore were from non-tier 1 and tier 2 cities, underscoring diffusion of financial participation beyond traditional urban centers. In financial year 26, debt market accounted for over 63% of total resource mobilization from primary market in April to December 25. Government and SEBI initiatives to deepen bond market contributed to the value of corporate bond issuances reaching 6.8 lakh crore by end of December 25. Private placements accounting for more than 99% of total resources mobilized through the bond market remained the preferred move. Institutional investors are shown to exhibit structural preferences influenced by return profiles, risk assessment, regulatory incentives, and prevailing market liquidity conditions. They tend to favor equities and government securities over corporate bonds. This trend may be contributing to constraining of corporate bond markets growth and development. As notified by Niti Aayog report, limitations also stem from regulatory overlaps between SEBI, RBI, and Ministry of Corporate Affairs, extensive disclosure requirements that deter lower rated issuers, restricted investment mandates for institutional investors, limiting their allocation to high grade securities, and underdeveloped risk management infrastructure. Additionally, weak debt recovery mechanisms, high transaction costs, tax asymmetries reduce investor appetite and limit flow of long-term capital. India's foreign portfolio investment trends exhibit volatility. As of 13 January 2026, FPIs are net sellers of Indian equities with outflows amounting to 16.5 thousand crore. In midst of volatile foreign capital flows, domestic institutional investors, particularly mutual funds and insurance companies, have counterbalanced volatility of foreign investment flows and provided support to markets. With continued buying as of 30 September 2025, DII ownership within NSE listed equities stand at 18.7%. The achievements and progress made by India's maiden international financial service center at Gift City in Gandhinagar provides a glimpse into India's advancement towards creating enabling ecosystem for attracting and channeling global capital. International Financial Services Centers Authority, established in April 2020 under IFSCA Act 2019, serves as Gift City's unified regulator with mandate to develop and regulate financial products, services, and institutions within the IFSCs. Prior to GIFT City's establishment, many Indian companies raised funds or managed offshore investments through jurisdictions like Singapore, Mauritius, Cayman Islands due to more favorable tax and regulatory frameworks. IFSC architecture aims to bring back financial services transactions currently conducted outside India by overseas financial institutions and overseas branches of Indian financial institutions to Indian shores. Enactment of Sabka Bima Sabki Suraksha Act will usher weighted reforms in insurance sector. Increase in FDI limit to 100%, accompanied by other amendments, paves way for ease of doing business, entry of more players, enabling expansion of the sector to address production gaps. In the external sector, India focuses on playing long game. Total exports amounted to 825.3 billion US dollar, registering 6.1% growth, the highest levels of exports ever recorded. At same time, country's total imports also increased by 7.4%, stood at 919.9 billion US dollars. Surplus in services trade cushioned merchandise trade deficit, and consequently in financial year 25 total trade deficit amounted to 94.7 billion US dollar. During financial year 20 to 25, India's merchandise exports grew with compounded average growth rate of 6.9%. Agriculture exports increased from 34.5 billion US dollar in financial year 2020 to 51.1 billion US dollar in 25, registering CAGR of 8.2%. India is world's second largest agriculture producer by value. Disparity between production value and export performance highlights significant untapped potential for expanding trade in agriculture products. Country has potential to reach 100 billion US dollar of combined exports of agriculture, marine products and food and beverage in next 4 years. Agriculture exports are influenced by a range of supply side factors including food security, processing facilities, infrastructure bottlenecks and regulations. However, given volatility in domestic price and production of commodities, trade policy has been employed to achieve short-term domestic objectives such as managing inflation through product specific interventions, including ad hoc export bans and imposition of minimum export prices. Frequent policy changes can significantly disrupt export supply chains, create market uncertainty, and cause foreign buyers to switch to other sources. Export markets, once lost, are not easily recovered. India is currently subject to an effective export tariff rate of 50% on goods exported to US, and this rate is among the highest imposed on any country. To enable exporters to leverage benefits from FTAs and provincial trade agreements, Tariff Explorer's service on the Trade Connect e-platform provides information on tariff concessions available to eligible exports from the country. Furthermore, Export Promotion Mission establishes comprehensive, flexible, and digitally driven framework for enhancing export initiatives. This approach signifies strategic transition from numerous fragmented schemes to unified outcome-oriented mechanism capable of responding to global trade challenges and evolving needs of the exporters. Private transfer receipts, mainly representing remittances by Indian employed overseas, remained key source of external sector strength in financial year 26. Remittances increased to 73 billion US dollar in 26, up from 64.7 billion US dollar in same period in previous year. According to RBI data, gross FDI inflows into India stood at 81 billion US dollar, representing 13% increase from 71.3 billion US dollar in 24. Of this gross FDI inflows, equity inflows accounted for 51 billion US dollar, and approximately 60% of these flows were directed towards services, computer software and hardware, trading, non-conventional energy, construction and automobile sector. FDI outflows from India increased to US dollar 22.1 billion US dollars. India's foreign exchange reserves increased to 701.4 billion US dollar as of 16 January 26, up from 668.3 billion US dollars at end of March 25. Increase has come at a time when global interest rate differentials, capital flows, and commodity prices remain volatile. This expansion in reserves has helped steady India's external position despite shifts in global risk sentiment and episodes of portfolio inflows. Foreign currency assets, which form liquid core of reserves, softened slightly from 567.6 billion US dollars to 560.5 billion US dollars. In contrast, gold component rose sharply to 117.5 billion US dollars compared with 78.2 billion US dollars. Between 1 April and 15 January 26, Indian rupee depreciated by approximately 5.4% against US dollar. This movement was somewhat larger than immediately preceding period, making INR one of the most depreciated currencies. The next chapter focuses on tamed and anchored inflation. India has recorded one of the sharpest declines in headline inflation, amounting to about 1.8 percentage points. Over past 4 years, average retail inflation, as measured by Consumer Price Index, has followed clear downward trajectory, declining steadily from 6.7% in financial year 22-23 to 1.7% 25-26. The next chapter was on the agriculture and ensuring food management, raising productivity, and securing income. Agriculture and light activities contribute nearly one fifth of India's national income at current prices, but account for 46.1% of country's workforce. Over the last 5 years, average annual growth rate in agriculture and line sector has been around 4.4% at constant prices. In Q2 of financially 25-26, agriculture sector registered growth of 3.5%, decadal growth of 4.45%, highest in comparison to previous decades, has resulted from strong performance in livestock about 7.1% and fishing and aquaculture 8.8%, followed by crop sector at 3.5%. Key factor limiting crop productivity is limited availability of quality seeds. Access to assured water through irrigation is a key driver of agriculture productivity. Declining soil health, particularly in soil organic carbon, poses major challenge to agriculture productivity in India. Access to institutional credit boosts agriculture productivity by investment in quality inputs, mechanization, irrigation, improved technologies, and climate resilient practices for small and marginal farmers. Insurance and cooperatives also play a key role in boosting agriculture. Organic and natural farming still cover small fraction of total cultivated land. Limited availability of quality inputs, uneven adoption of improved practices, and gaps in extension services constrain scaling. National Food Security Act was introduced to provide legal guarantee of subsidized food grains to nearly 67% of India's population. Indian agriculture is entering new phase of opportunity supported by advances in irrigation, digital extension, improved storage, and strengthening of cooperatives and value chains. Strengthening private sector participation in areas like food processing, cold chain logistics, and development of high value agriculture products will be crucial to increasing competitiveness in domestic and export markets. Expanding high growth sectors like horticulture, agroforestry, dairy, poultry, fisheries can further support inclusive economic development and job creation for rural communities. Next chapter focused on global services trends and performance of Indian services sector. Currently, India's services sector contributes more than half of gross value added and serves as major driver of exports and employment in country. It has emerged as most stable and resilient component of GDP, acting as high growth, low volatility anchor, as is case across the globe. The sector recorded average annual growth of around 7 to 8% year after year, in sharp contrast to more pronounced cyclical fluctuations observed in agriculture industry. India is world's seventh largest exporter of services, with its share in global services trade more than doubling from 2% in 2005 to 4.3% 24, and the sector continues to be the largest recipient of foreign direct investment inflows. Subsectoral data reveal financial, real estate, and professional services sector remains key driver of service growth. Domestic tourism remained backbone of this sector, with visits increasing by about 17.5% in 24 over previous year and nearly 52.7% during January to September 25 compared with corresponding period last year. Supported by cost competitiveness, skilled medical professionals, established healthcare infrastructure, medical and wellness tourism has emerged as key comparative advantage for India, offering high value non seasonal tourism. India's vast coastline offers scope to unlock blue economy through modern marina infrastructure. Marinas, the purpose built harbors for recreational boats and yachts with moorings, fuel, maintenance, hospitality, and water based tourism facilities are virtually absent in India. This constrained growth of pleasure yachting and small vessel building, limiting critical first step towards broader mass scale development of shipping infrastructure, key policy focus of the government. National Marina Development Policy that enables private players to run marinas under transparent permit regime could support sailing, driving, and leisure cruising. This would help attract high value tourism and international regatta events like Swan Cup National Regatta, Being employment intensive, it could generate more employment in coastal regions along with additional income for fishermen. This could revive uneconomical ports and promote sustainable coastal development. Media and entertainment sector has also become a significant component of India's services economy, spanning audiovisual production, broadcasting, digital content, animation, and gaming, advertising, live entertainment. While technologies are enhancing productivity and enabling new service models, the pace of change is outpacing workforce and firm level adaptation. Many economies face widening skill gaps, rising demand for specialized capabilities in areas like data analytics, cybersecurity, cloud computing, and AI, along greater automation of routine services. For IT enabled services, sector's future hinges on timely reskilling, wider diffusion of digital technologies, and creation of supportive policy environment for innovation and scaling. Key reforms include unique requirements of data centers such as access to green energy, facilitating visas for skilled professionals, providing tax clarity for digital services, need to promote mission-driven industrial linked research, and predictable funding and strong public-private collaboration. Tourism requires creation of niche segments like long distance hiking trails, national marina development policy to unlock blue economy, streamlining permissions for live events, opening heritage venues, facilitating foreign artist participation will help realize potential of concert and orange economies. Space and ocean services are also poised for rapid expansion through commercialization and public-private partnerships. The next chapter talks about structural transformation and global integration of the industries. Industry gross value added grew by 7% year on year in first half of financial year 25-26, marking clear pickup after growth has eased to 5.9% previous fiscal year. India is second largest cement producer in the world after China. India's cement industry comprises 160 integrated large cement plants, 130 grinding units, 62 mini cement plants. Current annual installed capacity of cement industry in India is about 690 million tons, with cement production of around 453 million tons in financial year 25. Steel sector serves as backbone of industrialization and infrastructure, securing India's position as world's second largest crude steel producer. This sector has undergone major transformation in last 5 years, largely by strong domestic demand from construction and manufacturing. This sector faces challenges related to international price disparity and raw material security. India was net importer of steel during financial year 26 between April to October due to low international prices, which resulted in lower margins on exports and cheaper imports. While India is largely self-sufficient in iron ore, industry faces critical dependence on imported coking coal. Automotive industry is significant driver of economic growth, with India established as world's largest market for two-wheelers and three-wheelers and third largest market globally for passenger vehicles and commercial vehicles. Supported by vast manufacturing and auto component system, this sector provides direct and indirect employment to over 30 million people and contributes to public finances, accounting for nearly 15% of country's GST collection. India's electronics sector has undergone structural transformation, ascending from the seventh largest export category in financial 22 to third largest and fastest growing in financial 25. This momentum continued into first half of 26 with electronics exports reaching 22.2 billion US dollar, positioning sector on track to become second largest exported item. To finance innovation at scale, government also announced new research development and innovation fund with total outlay of 1 lakh crore over 6 years and 20,000 crore allocated for financial year 26. This fund is designed to catalyze private investment in high-tech research and development support projects at advanced technological readiness levels, enable acquisition of strategically important technologies and operationalize a deep tech fund of funds. Together, the ANRF, the National Missions and RDI Fund form consolidated architecture for expanded India's GERD beyond its current level and accelerating India's transition towards technological leadership and broader objectives of Atmanirbhar Bharat. As India considers manufacturing strategy amidst the economic transformation, geopolitical uncertainty, and technological change, manufacturing capacity needs to be viewed as strategical national asset. It is central to employment, productivity, technological learning, exports, and strategic resilience and warrants mission oriented approach beyond purely incentive based interventions. Next chapter talks about strengthening connectivity capacity and competitiveness and investment in infrastructure. Government of India's capital outlay has increased by nearly 89% from 5.92 lakh crore in financial year 22 to a budgeted allocation 11.21 lakh crore for financial year 26, recognizing strong multiplier effects that infrastructure can generate in the economy. Next chapter talks about building resilient, competitive, development driven India with focus on environment and climate change. This chapter in the report shares that development is in itself a form of adaptation. While emission mitigation is also important, effective climate action encompasses much more. It depends on improving societal capacity to withstand shocks through stronger health system, climate resilience, infrastructure, enhanced agriculture productivity, access to affordable and reliable energy. Measured in terms of human welfare rather than temperature outcomes alone, most effective strategies are those that expand opportunity while reducing vulnerability, remaining transparent about uncertainties, and pragmatic about limits of what climate science can presently resolve with confidence. Education and health sectors are also important and are talked about in the next chapter. The Right to Education Act 2009 and National Education Policy 2020 played crucial role in shaping education landscape by expanding access to quality education universally, promoting equity and driving innovation in teaching and learning. Next chapter talks about employment and skill development. India has recorded significant employment growth supported by structural reform, tax realization, and sustained focus on skill development. Measures like deregulation, GST 2.0, labor reforms implemented by states have contributed to rising labor force participation and employment growth across industry and the services. Next chapter talks about rural development and social progress. Social mobility and equal opportunity are key to thriving societies and economies. These have been challenging goals to meet. Equality of opportunity ensures greater social mobility by providing equal and merit driven framework for personal progress. The report also talks about the evolution of AI ecosystem in next chapter. AI development is inextricably linked to physical infrastructure. Data centers require large quantity of electricity and water, and AI workloads introduce volatility into power demand, posing risk to grid stability. Global experiences show that AI-driven data center expansion can place significant strains on existing energy systems even in advanced economies. For India, as power, finance, and especially water remain binding constraints, scaling compute indiscriminately carries opportunity costs. Investment in AI infrastructure competes directly with other sources of demand like households and industries. This creates trade-off between centralized scale and distributed efficiency, strengthening case for smaller task-specific models that can run on limited hardware and decentralized compute networks. The next chapter in the report mentions urbanization making India's cities work for its citizens. India's urban population rapidly expanded in absolute terms with large metropolitan regions such as Mumbai, Delhi, Bangalore, Chennai, and Hyderabad now ranking among world's largest urban agglomerations by population. However, population scale has not translated proportionately into urban productivity, livability, or global economic influence. In advanced and emerging economies, small number of metropolitan regions function as nodes in global production networks, financial system, logistic chain, and knowledge ecosystem. Despite India's economic scale today, its cities struggle to perform at the level of established global cities like New York City, London, Shanghai, or Singapore. In India, urban infrastructure investment in domains like transport, housing, water sanitation, and governance capacity has lagged behind economic importance of cities. This has led to high population density, manifesting as congestion, informalization, and infrastructure stress, diluting productivity gains. This divergence raises important structural question. Why has India's economic growth not translated into globally competitive cities, and what constraints prevent Indian cities from fully realizing agglomeration-led growth? Cities become economically central, however, they remain politically peripheral. Electoral, fiscal, and administrative responsibilities remain distributed across multiple tiers of government. This institutional structure can constrain ability of city governments to mobilize revenues, coordinate planning, and take long-term investment decisions in the metropolitan scale. This limits political ownership of urban outcomes and reduces incentives for deep institutional reform. This results in a model in which cities function primarily as implementation units rather than autonomous economic actors. Global cities compete, Indian cities comply. Reason why land remains unproductive is in unclear land titles compounded by fragmentation and opaque records. Secure transferable property rights are essential for land to function as capital. The next chapter talks about import substitution, strategic indispensability, and resilience. In February 25, government offered significant relief to households by raising minimum tax threshold to 12 lakhs for individuals. Family of two income earners would not have to pay tax on annual income of up to around rupees 26.7 lakhs. Following the surprise of reciprocal tariffs and penal tariffs imposed by US government on India in April and August, Indian government intensified negotiations with other countries to open more markets for Indian exporters. Government also passed relief package for exporters and announced 5-year export promotion package to support expansion into new geographies. More than 2 decades after end of first technological bubble, America and some parts of world are betting heavily on a boom in artificial intelligence, reshaping how we work, how we secure ourselves, and how we learn and teach. The report says that where techno optimism leads, financial engineering follows. In this instance, history may be repeating itself by rather than just rhyming. For the time being, development of AI has proceeded along resource intensive lines. This intensification of energy demand is reflected in sharp projected rise in electricity consumption by data centers across major regions. Grids have become unstable, power supply is disrupted, and energy costs have risen, compounded by the push towards intermittent power sources like solar and wind. Frugal AI may be possible, but it is not yet on the horizon, nor is it yet on a commercial or global scale, says the report. The US federal government has prevented states from regulating AI. Not just critical minerals and rare earths, but even basic metals will face supply constraints as demand surges and supply tightens due to both natural and nationalistic reasons, stating that 20th century ran on oil and steel and 21st would run on compute, shorthand for computing power or graphic processing units, and the minerals that feed it. America announced Pax Silica declaration with few like-minded countries aimed at building AI ecosystem of tomorrow from energy and critical minerals to high-end manufacturing and models. In meantime, US passed the Genius Act, guiding and establishing national innovation for US Stablecoins Act in July 25, which would take effect from January 2027 or 120 days after implementation regulations are issued, whichever is earlier. Regulated private sector institutions can issue US dollar backed stablecoins. Depending on its success, it carries potential to disrupt capital flows to emerging and developing economies. Much of India's external financing has come through portfolio flows, debt inflows, episodic surges of foreign investment. These flows are valuable, but they are not conditional and reversible. They respond not only to domestic fundamentals but to global liquidity cycles, risk sentiment, and geopolitical developments beyond India's control. Currencies backed primarily by capital inflows behave differently under stress than currencies backed by persistent export surplus. In moments of global risk aversion, capital retrenches. Exchange rates adjust, sometimes abruptly. Central banks can help smooth volatility, but they cannot permanently offset structural imbalances through reserve accumulation or interest rate adjustment. This is hard constraint, confronting India's macroeconomic aspiration, and India has already felt its impact this year. High market valuations, questions over long term trajectory of Indo American relations, stemming from America's imposition of high tariffs of India and establishment of warm relations with Pakistan, prompted portfolio investors to take profits and wait on the sidelines. While FDI inflows have improved, they have not been enough to offset large portfolio outflows. Further, Indian companies have also been required to invest in other countries due to rising trade restrictions. One has to produce locally to be able to sell locally. With India running an overall trade deficit because surplus in services trade does not offset deficit in goods trade, and with remittances and net invisibles also insufficient, India relies on global capital inflows to finance its imports. When that fails to materialize to extended aid, currency is vulnerable to depreciation. As 2025 drew to close, China made significant announcement regarding Hainan Island. The Hainan Free Trade Port is China's bold experiment to open economy more extensively than anywhere else on the mainland. Instead of being just a city or small zone, whole island province of Hainan has been turned into special trade and business area with very relaxed rules on trade, customs, taxes, investment, and visas. For India, Hainan's free trade port is best understood not as single disruptive shock, but as gradual structural development that certainly changes economics of trade, logistics, and investment in China's near neighborhood. In practical terms, it creates large, low tariff services heavy economic space in northern reaches of Indian Ocean and South China Sea, which could over time influence patterns of supply chain routing, tourism flows, and corporate investment decisions in Asia. As a country dependent on global capital flows, India has plans for liquidity and external capital buffers in coming year. Capital flight, including with the advent of US stablecoins, is another risk to watch out for. India will remain better placed than most in its ability to maintain decent growth rate, but its resilience will be tested as strategic vulnerabilities persist due to external dependence for capital, energy, and other critical inputs such as fertilizers. India will have to be prepared for prolonged period of geopolitical uncertainties and conflicts as well as consequent disruptions in developed societies. It is quite possible that period between now and 2045 might resemble interwar years of the 20th century. Of course, numerous innovations occurred during 1930s amidst the Great Depression and onset of war. The war itself contributed to growth of industrial capacity, but that later served the global economy well. But to survive such a turbulent period and to turn necessities into innovations requires not a defensive but proactive or offensive policy framework. Indeed, contours of a more uncertain and strategically contested world are already visible in international economic environment confronting India today. In a world where economic relationships are increasingly strategic and contested, ability to learn selectively becomes core element of statecraft. Epic Ramayana provides valuable metaphor for strategic learning in complex and contested environments. In the Yuddh Kand, moment of Ravana's defeat becomes lesson in discernment as Lord Rama reflects that insight may be drawn even from adversaries without inheriting their values or methods. The teaching is subtle yet powerful. Learning is compatible with autonomy. In today's fragmented global economy, capacity to learn without dependence becomes an essential strategic skill. Policy question is no longer whether states should encourage Swadeshi, but how it should do so without undermining efficiency, innovation, or global integration. Import substitution is justified when domestic production is already feasible at reasonable cost, but is impeded by non economic factors such as coordination failures or legacy regulatory burdens when temporary and explicitly time bound production can facilitate learning, scale building, and productivity gains when protected industry is subject to export discipline and measurable performance benchmarks, and when good concerned is strategically critical even if cost disadvantages persist. These conditions differentiate intelligent import substitution from indiscriminate sheltering of domestic incumbents. The second part of this chapter discusses strategic resilience and indispensability and role of state, private sector, and citizens. India's difficulty lies in the fact that its institutional environment has evolved in ways that place asymmetric burden on visible action relative to procedural continuity, especially under conditions of uncertainty. Temporary measures have often become permanent through what might be called irreversibility creep, raising the stakes of any experiment. Good faith decisions are subjected to retrospective scrutiny through audits, vigilance processes, judicial review, often without adequate recognition of uncertainty under which they were taken. Entrepreneurial initiatives are evaluated using metrics suited to routine administration like compliance, revenue collection, procedural correctness, rather than learning, capacity creation, or long term impact. Politicians drift into populism while bureaucracies drift into insularity. An entrepreneurial state requires more subtle division of labor. Political leadership must set direction and articulate priorities. Bureaucracies must discover pathways, solve problems, and adapt instruments. Institutions must absorb error without collapsing into paralysis or permissiveness. Whether a bureaucracy is becoming entrepreneurial can only be assessed through learning capacity. Legal and institutional frameworks must codify protection for good faith decision making and clearly separate error from corruption. For India to have entrepreneurial state, it sorely needs honest officials must be protected from vexatious prosecution, where complex regulatory or economic decision is being alleged to be ill motivated but without clear evidence of quid pro quo. Answer is difficult. Law will need to weigh this without making economic decision making risk averse. India will face decisions for which there will be no manuals. In each case, outcomes will depend less on the correctness of initial choices and more on states' capacity to learn, revise, and act with confidence under uncertainty. Most regulatory processes, including approvals, investigation, enforcement action, disputes, and appeals, are driven by money. Delay, therefore, impose real economic cost. To address this, decisions must be subject to strict timelines with provisions for deemed approvals when authorities fail to act within prescribed periods. Economic laws should specify timelines for every stage of regulatory action with consequences for non compliance. Just as obstructing public servant is penalized, failure by authorities to deliver services within mandated timelines should be treated as obstruction to economic activity. Moving from discretionary, open ended processes to enforceable deadlines is essential for embedding respect for time value of money within the regulatory system. Where delayed gratification weakens, systems begin to substitute shortcuts for capability, visibility for depth, and speed for learning. Impact of deregulation is evident in state level case studies. In Andaman and Nicobar Islands, introduction of online processes for change in land use led to the disposal of hundreds of applications within months, creation of additional tourism capacity, and visible improvement in household and entrepreneurial credit flows. In Tripura, comprehensive reform program covering land, building regulation, labor, utilities, and overarching statutes have delivered measurable results. Manufacturing exports participation in global value chains act as institutional stress tests, exposing weaknesses that sheltered activities can conceal. In more uncertain world, risk is unavoidable. Advantage lies in managing it better. Countries that can act before certainty emerges, correct course without paralysis, and align incentives across states, firms, and citizens are better placed to convert growth into influence. State capacity is therefore not administrative concern at the margin. It is foundation on which strategic resilience is built and pathways through which strategic indispensability becomes possible. The report ends with a quote from Sir Mark Tully in the ninth Nani Palkhiwala Memorial Lecture in Chennai on February 12, 2011, which says if India is to truly fulfill its potential, it must move from a ruler's Raj to a citizen's Raj.